This is the Bloomberg Daybreak podcast, available every morning on Apple, Spotify or wherever you listen. It's Wednesday, the 28th of February in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, executives at some of Wall Street's biggest banks praised Paris, but warned that French labour protections could hurt further expansion.
Apple ditches its much-hyped plan to build an electric car, with some staff going to AI.
And we look at why central bankers who used to keep out of politics are now wading in.
Let's start with a roundup of our top stories.
Wall Street's biggest banks have seen staffing levels surge in Paris since Brexit, but now executives are warning further expansion could be limited by France's strict labour protections. Representatives from JP Morgan, Citigroup, Goldman Sachs and Morgan Stanley were speaking at a Bloomberg event in the French capital. Here's what Cécile Ratcliffe, Citigroup's chief country officer for France, told us.
We had 170 people before Brexit. Now we are more than 400, and we have extended the office, opened a second trading floor to be able to cope up to 600 without having to move again.
Despite Cécile Ratcliffe's upbeat tone, executives also warned that the cost of labour and the difficulties in being able to cut staff in a downturn were factors in considering more hiring. The comments come as the world's largest banks have shed thousands of jobs in recent months amid a dearth of deal-making.
Apple is cancelling its decade-long effort to build an electric car. The multi-billion-dollar project, dubbed Project Titan internally, began in 2014 and would have vaulted Apple into a whole new industry. The decision to wind down the unit came as a relief, though, to investors who sent shares climbing after Bloomberg reported the news. Bloomberg's chief correspondent, Mark Gurman, broke the story.
This is a bombshell development. This is a very rare retreat for Apple. This is a project that they've invested over $10 billion in. They've worked on it for over 10 years. It's had many fits and starts. It's had many directional changes.
Mark Gurman's reporting suggests that as many as 2,000 employees currently working on the project will be shifted to the firm's artificial intelligence division. It is understood that there will be layoffs, even if it's unclear how many.
The Swedish fintech Klarna is sounding out investment banks ahead of a potential initial public offering of shares in the United States. According to people familiar with the matter, the stock market listing could happen as early as the third quarter of this year and value the buy now, pay later giant at around $20 billion. Going public might spell the end of a difficult period for the company, which saw its valuation fall from $45.6 billion in 2021 to $6.7 billion the following year.
And now to some macro thoughts. Goldman Sachs' CEO David Solomon says that softer spending by consumers calls into question expectations that the US economy will avoid a recession. Bloomberg's Charlie Pellet reports.
Solomon told a UBS group conference, quote, "The world is set up for a soft landing." He added the market certainly perceives there's a very, very high delta to a soft landing. My own view is it's a little bit more uncertain than that. Solomon said business chiefs have told him that with prices still high, a pattern of tightening in paycheck-to-paycheck spending behaviors has emerged. In New York, Charlie Pellet, Bloomberg Radio.
The Bank of England Deputy Governor Dave Ramsden says the central bank might sell off its entire QE portfolio. It's a move that would split the Bank of England off from the Fed and the ECB and could mean bond sales worth hundreds of billions of pounds coming to market. Bloomberg's James Wilcock has more.
The BOE launched quantitative easing in 2009 during the financial crisis to avoid a depression. Rates were low, and in the early years the bank made a profit of £124 billion, which the UK government gladly spent. But now it's becoming a political risk, with potential net losses of £100 billion. That would be covered by the taxpayer. This might explain both Ramsden's comments and why the bank's selling bonds at nearly twice the rate of the Fed and the ECB. The question is, how much of its £735 billion portfolio will be put on the market? In London, James Wilcock, Bloomberg Radio.
And finally, a return to office policy at Deutsche Bank is sparking backlash from employees. The bank told staff 2 weeks ago that all employees would be required to come in at least 3 days a week, starting in June. According to a memo seen by Bloomberg, a large number of workers criticised the move, prompting CEO Christian Sewing and COO Rebecca Short to plan renewed discussions about the changes. The criticism is largely from staff in Germany, where a labour union is demanding a 14.5% wage rise for staff in several units. Now, in a moment, we'll bring you more about what top bankers are saying around their expansion plans for Paris, plus why European central bankers are stepping into unknown territory when it comes to politics. But first, in terms of that news about Apple dropping the project to develop an electric car, it is really worth a read. There's a piece out on it also by our opinion columnist Dave Lee. I mean, still trying to work out exactly why Apple made this surprise move, perhaps lack of progress.
I've really enjoyed Dave kind of delving into the fantasy world of what could have been with Apple's self-driving car, talking about perhaps they may have been the first ones to go to full self-driving. That was one of the things that's been reported about this project over the years as well. He said his favourite report of all time was Apple looking into a deal with McLaren that could have created a British supercar with Apple's help as well. And he sort of says that there could always, even with the cancellation of this project now, that there could be rumours of an Apple car being worked on somewhere in the bowels of Cupertino for years to come.
Look, that's the fantasy vehicle, right? I mean, if it were as slick as the Apple iPhone, which no doubt that's what Apple would want, the reality, though, of creating that vehicle, perhaps a little bit more difficult.
Well, for now anyway, that project is on ice. Well, let's get more now on our top story in the evolution of Paris's financial industry. Major banks have added staff in the French capital since Brexit, but they're warning that they're hesitant to hire more because of French labour protections. Senior executives from Goldman Sachs, Morgan Stanley and JP Morgan have been speaking at Bloomberg's Paris office.
The labour market is complicated in France. Having more flexibility is something that is important to all of us. And when you grow headcounts in an important way, it becomes more and more important.
We are a cyclical industry, and that we need to be able to be flexible on headcounts.
You need to tell the juniors, the graduates, if you want to have an international career, you can go to London, you can go to New York, but you can also go to Paris, because Paris is becoming much more international now.
So that was Marc Dandelot from Goldman Sachs, Emmanuel Goldstein from Morgan Stanley and Alexis Steinman from JP Morgan, all of whom lead their bank's French operations. They were speaking to our editor-at-large, Francine Lacqua, and Fran joins us now. Morning to you, Fran. These are Wall Street banks who've all expanded rapidly in Paris since Brexit. It's something that couldn't have been imagined a decade ago. Are they happy with their moves in France, and is there room for further growth?
Well, that's $1 million question, Stephen. And so I was in Paris actually to launch the French newsletter of our bureau, and it was incredible to see so many bankers all together trying to speak to each other. We had a full room. I think people were standing at the back. It was interesting speaking to the heads of Citigroup. We had Goldman, we had JP Morgan and others. And they were saying, look, it's amazing how much, as you say, maybe unthinkable just a couple of years ago, how much they've grown their headcount. I mean, Citigroup now has 400 people in the French capital. JP Morgan has 900. Morgan Stanley expect more, staff, for example, in quantitative research. And they were making the point that because of French innovation, but also because of French education, there are very good quants out there. What was interesting in the conversation going forward is that these were country heads saying, look, it's been brilliant. We've had the staff. We've been able to relocate. People want to come and live in Paris compared to other cities. But there's always going to be a plateau unless the labor reform changes. So it was interesting because it was quite a candid conversation. And they were talking about the fact that it's not really difficult to get bankers to come to Paris and move to Paris, but it's difficult back home, New York, where their head office is and their chief executives are of the big group banks, to convince them to have more staff in Paris just because of the labor laws being so restrictive. So it's expensive, it's difficult to fire people. And so they say, the main barrier is basically the overall, of course, treatment of workers. And they said it's very important, but maybe white-collar workers could be treated differently to some of, the workers that need more protection.
Well, that sort of sets up quite some clash, doesn't it, between the sort of standards that the US has versus the labour protections that France has. President Emmanuel Macron's government has put a lot of effort into trying to make France more attractive to these sorts of businesses. Is there flexibility? What is being said about, the warning around the rigidity of labour protections?
Yeah, so that was the number one thing, Caroline, that really came out. And it was incredible to have all five, of course, people on the panel really supporting Emmanuel Macron and saying, look, none of this would have been possible without Macron. Of course, Emmanuel Macron, also former banker. And it's very clear that when he came into power and he saw opportunities for Brexit, remember the famous word, I'm rolling out the red carpet, that made so many people back mad in London. And so, again, the move is quite complicated because if you look at the move of bankers to Paris, two people on the panel actually said, I was happily living in London for 17 years. I didn't really want to come back to Paris, but they were obliged by their banks. But the move comes as there's been this fight between Paris and Frankfurt and Madrid and Dublin and others to be financial hubs. And because of incentives, for example, bankers that return to France have better tax advantages for the first 5 years. They've been able to do so. But then going forward, it's unclear how much Emmanuel Macron wants to give, of course, to banks and financial services without changing labor reforms as a whole. And then you, of course, then have the budget here in the UK with the Chancellor thinking of extremely compelling arguments. He was saying, for example, he was very attracted to the idea of creating a tax-free savings account, and that would really boost the struggling stock market in the UK. And that's something that Paris would probably look at quite jealously.
Fran, was there a conclusion from your panel that peak Paris has been reached, or is this something that there could be further to go on?
Yeah, I think the panel was a little bit, if not downbeat. They said, look, we've had it really good, and now it's going to be much more difficult to grow from here. I think the only, green shoots of hopes is that 2023 was an extremely difficult year for all banking because of the mismatch in some of the prices that they're trying to buy, because the capital markets was basically frozen because they've had to fire, of course, or get rid of a large number of headcount because of the slack also in pipelines and IPOs. And if you look at that, globally, I think we had hundreds of thousands of layoffs. For someone like Paris that is doing quite well in Europe, but is actually losing a lot of staff to New York or Hong Kong or other hubs, maybe Singapore more than Hong Kong. They were seeing, the first green shoots of 2024, saying it's going to be a better year for the banking system as a whole. And so Paris will obviously benefit from that. But I think unless the labor reforms, change, it'll be probably difficult for these group heads to hire more.
Okay, Francine, thank you so much for joining us. Our editor-at-large, Francine Lacroix, there in Paris. Well, Fran mentioned that you can read all of Bloomberg's coverage from France in a new weekly Paris edition newsletter. You can sign up at bloomberg.com/newsletters.
Now, Bloomberg has learned that Apple has abandoned its decade-long effort to build an electric car and will shift some of the team's 2,000 staff to its generative AI division. Investors cheered the move with Apple shares ending higher. Bloomberg's chief correspondent, the man who always gets the exclusives on Apple, Mark Gurman, joins us now for more. Morning to you, Mark. Can you talk us through what we know about this decision by Apple?
We know that Apple, Tuesday morning California time, announced internally amongst its special projects group, that's the team that has been developing the car for the better part of a decade, that the project is winding down. Some of the people, like you said, would be moving to Apple's AI teams. Other people would be working on Apple's core operating system and software teams. Other people would be laid off, and other people are going to have to search for new jobs within the company, particularly those working on car hardware. This is a bombshell development, a significant revelation for the company coming to this decision. The car has many fits and starts. It's been mired by leadership failures, infighting amongst executives, different opinions on what types of technologies Apple should use. And they're finally, so to speak, pulling the plug here, or the electric plug, I should say, on the car project.
Okay. And they didn't actually produce a car. Is this a defeat for Apple? Is it a strategic move? How do we think about it?
Oh, it's 100% a defeat for Apple. It's being spun as a strategic move in terms of how they're reallocating resources. The idea, though, is that they're only reallocating these resources because they don't need them for the car anymore because they're not making a car. It's a chicken and the egg question, or the egg question. Did Apple do this to put resources on generative AI? Or did Apple do this because they needed somewhere to stick all these people after the generative AI efforts failed? And it's obviously, in my view, the latter. They have a soft landing for these people because they're talented and useful for the AI efforts, for other software engineering efforts. But this only happened because Apple failed to build the car, not because they needed those people.
Is this symptomatic of a broader move from Apple away from big, bold, new projects? It's often referred to, since the iPhone, have the developments been of the same scale? Is this a bigger change in behind the scenes in Apple?
I don't think there's a bigger change. I think Apple is still a company that relies on blockbuster new hardware products, right? Hardware is still where they get 80% of their annual revenue. And the only way to really grow that revenue in a meaningful and a significant way was a car. So from that standpoint, they need to do some soul searching now about what the next big initiative of the company is going to be. We know it's no longer the car, but what else can add $2 trillion to your underlying market cap? In my view, nothing. But I'm sure they'll come up with another direction. And if they don't, it's not going to be so pretty.
Perhaps no story about in the EV space would be complete without a little reference to Elon Musk, who did send out a post on X on Twitter. Sort of not critical, but just an emoji that looked as if he was looking quite pleased about what happened in terms of Apple's failure. But even his business has found it quite difficult in the electric vehicle space, right? It took off incredibly well. It's had difficulties this year.
Oh, Elon Musk's business has had difficulties, but don't forget, they're still raking in $100 billion a year on these cars. They're still shipping new products. They've still figured out a way to get it done, whereas Apple certainly has not figured out a way to get it done in the car space.
Does this mean this project could never be revived? Could we perhaps, under a different leadership team, see the idea of Apple coming back to its car?
Certainly could be revived. I don't anticipate that happening. More likely would be Apple acquiring an existing car maker and then putting resources around that, sort of build around an acquisition rather than go at it alone. I think the ship has sailed on the car. They've had too many fits and starts, and you can't really put the genie back in the bottle.
Why did it not work, Mark? I mean, they make so many other bits of hardware, and you get the proposition, right? The kind of sleekness of an Apple iPhone, but car version with driverless, capabilities. Why couldn't they kind of deliver on the actual product?
There was infighting amongst executives. Really came down to the inability to create a car that would turn a solid profit. You had concerns if the technology would be readily available. You had concerns about certain levels of autonomy. You had concerns about safety and testing. And you had concerns if you were ever actually able to bring it to market during the end of this decade. So there were issues from end to end on this project.
Mark, what's the next big challenge for Apple? The headlines, of course, being dominated by this move. We've also been reporting about them meeting with the Department of Justice in a bid to avoid an antitrust suit. Where does Apple go from here? What's going to be the next big issue for the company?
Well, I think they have enough on their plate right now between the car and the Department of Justice. Potential lawsuit in the United States against Apple. Certainly in the European Union, you have the Digital Markets Act coming into effect on March the 7th. So certainly I think they have a lot on their plate right now. I can't speculate what their next issue is. But if I were to, you can add China and whatever is going to happen there to the list.
Absolutely. Mark, thank you so much for being with us. Great to have you on the programme and for your reporting, breaking this hugely important story around the abandoning of this decade-long effort by Apple to try to build an electric vehicle. As Mark was describing, not exactly sure what's going to happen with the 2,000 staff. Yes, some will be redeployed into AI, but as Mark was sort of saying, that's more necessity really than strategy, and that it definitely is a defeat for them in a new market, something that would have been a new market for Apple if they'd managed to get an EV car to market.
Yeah, thank you to our chief correspondent Mark Gurman for bringing us details of his exclusive reporting. Now, central bankers around the world have traditionally been scrupulous about insisting on their independence from politics, but the rise of anti-democratic groups and populists around the world has spurred European policymakers in particular to step into the fray. Our managing editor for European Economy and Government, Ben Sills, joins us now for more on this story. Morning to you, Ben. What is going on? What are these policymakers up to?
Well, we've seen a series of interventions, both from Christine Lagarde, the president of the ECB, and senior officials from the Bundesbank in Germany, make really quite extraordinarily political statements. We had Lagarde speaking at the Bloomberg House in Davos, who said that, Donald Trump is effectively a danger to the European economy and one which the Europeans should prepare for by kind of essentially going on the offensive. We had a senior Bundesbank executive actually appear at and speak at a anti-fascist rally in Frankfurt earlier this month, where she essentially came out and said the AfD, which is rising in the polls in Germany, is a threat to Germany, a threat to the economy. And this is really quite extraordinary for central bankers who, as you rightly said, have been extremely wary of getting anywhere close to politics until recently.
So it's really unusual, I suppose. Why is it happening now? It does seem to be that these central bankers are, they're trying to make it normal, the idea of, defending common values, democracy. Is that the sort of thrust of what they're saying?
Yeah, I think so. The Bundesbank, we asked the Bundesbank what their thinking was, and they said that they thought that it was entirely justified for them to speak out against what they called anti-democratic forces. It's not quite that simple, though, is it? Because the AfD might have some policy positions which are objectionable to some people, and I would obviously their plans for expelling large numbers of migrants is something that lots of people would oppose, and their plans for tearing down windmills is pretty foolish, to be frank. But they also have a lot of support from voters, and if voters decide that they want to see hundreds of thousands of migrants expelled from Germany, it might be an objectionable position, but I don't think that's necessarily anti-democratic.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.